Welcome back. It's that time for 3 Stock Lunch. Today we're sipping on some big movers. We've got Enphase higher on an upgrade to buy at Janney Montgomery Scott. They're bullish on solar. Fisker pacing for its best day in 2 years on that news. They'll begin deliveries of their first EV this spring and some profitability hopes. And Teladoc down 10% in the past week after an earnings miss and downbeat guidance for 2023. Here to help us trade all three is Courtney Garcia. She's Senior Wealth Advisor at Payne Capital Management and a CNBC contributor. Courtney, welcome. Start us off with Enphase. Would you be a buyer here?
I would actually. So Enphase, really solar and clean energy in general, it's long been seen as the future of energy, but it's been really hard to invest in profitably. And that's where I think something like an Enphase actually stands out, because not only is it profitable, but their gross margins are above 40%. And I really like that they have a strong balance sheet. They have about $1.6 billion in cash and less than $640 million in liabilities. Plus, they have a lot of free cash flow. So it really is going to lead them into a lot of more growth opportunities as we move forward. And lastly, I like that they have the ability to pass on their price increases to customers as they face things like supply chain issues or chip shortages that have affected them. But when you're in a higher inflationary environment, when you have the ability to pass on those costs to customers, that is really important, which they have proven to have. And so I think for all of those reasons, I'm optimistic here.
Well, let's move on, Courtney, to Fisker. What do you think?
Fisker, I'm not as optimistic on. Actually, I have a sell rating here. The problem here is profitability is going to become really important, especially in the higher rate environment. They're not only not profitable, they really don't have any revenue to show currently. So it is up on some news that they're going to finally deliver some vehicles earlier than expected now in the spring, which is great. But they really are still going to be facing a lot of the issues their competitors are with supply chain issues, issues with chip shortages, and they have really not a lot of room for breathing in their balance sheet. So they basically have enough cash to cover this year's worth of expenses, but not by a whole lot of margin. And so if they don't have the demand that they're expecting, or if there are any further supply chain issues, there's not a lot of room for error there. So I would not be a buyer here.
All right, Teladoc, that brings us to this one going the other way today. You a buyer of the weakness or seller sticking with the trend?
Sellers sticking with the trend here. Teladoc, again, is unprofitable. They're not expected to be profitable until probably 2025. But I really think this is a company who was benefiting from the trend during COVID, but now they face a lot of competition, not only from smaller competitors, but also the likes of an Amazon who just bought One Medical. And they're just currently... their free cash flow is deteriorating, and it's really not the kind of company that I'm going to continue to be in. And while they did have not a bad quarter they recently reported, their guidance was not very optimistic for future growth. So I would avoid this one again.
All right. Courtney, great to see you. Thanks for all your picks today.
Thanks for having me.
Courtney Garcia.